Hello everybody, welcome. Today we're going to go over a video that was going to look at bonds and the tax implications they have in Canada. So I'm assuming that many people already know the basics of bonds here. If you don't, you're going to have to go back and kind of refresh some of the basics of the bonds. But here we're going to really focus this video on taxation, and for many people, you're very familiar with bonds and the impacts that coupon payments, or really the interest payments here, will have, and they're going to be treated as what you would expect, right? They're going to be treated as interest income and really have no preferential tax treatment that we would see maybe with dividends or capital gains here in Canada. And there's tons of different kinds of bonds, okay? Whether we talk about government bonds or corporate bonds. Remember, we're going to talk about, fairly regular bonds here. We're not going to be talking about strip bonds or zero coupon bonds that are treated in a little bit different fashion in terms of not paying interest over the duration or the intervals of the coupon, but getting that all at the end of the bond. We're going to be talking about kind of regular plain Jane bonds where they're going to be paying some sort of coupon payment here. Typically we see this can come in a variety of different formats. Typically we see these semi-annually. This can be monthly. This can be yearly or annually, right? Lots of different ways they can come. And then again, this is going to be treated as regular interest. Now, many investors in Canada will see GICs, and GICs are technically a fixed income instrument, but a special kind of fixed income instrument. And many people will hold these instruments all the way to maturity, and we're not going to see any capital gains or anything come from those. So we're going to kind of leave GICs out separately, but sometimes if you do have a GIC and you don't hold it all the way to maturity and you do end up selling this for a price that is outside the ACB or adjusted cost basis or the principal amount that you paid for, you could have potentially capital gains associated with that, or capital losses depending on which way you went there. But typically, most of the times, you're not going to see that with GICs. And we also have Canada Premium Bonds and Canada Savings Bonds, both which are going to be discontinued here in 2017. So we really don't have to worry about those types of bonds. So like any asset, if we're going to do tax, we need to know really two main things for capital gains are the ACB, or the adjusted cost basis, and the proceeds of disposition. We're going to need these two, and we're going to do a couple of different examples, and I'll show you how we can get those two ACB. But also a key thing for bonds here is we're going to have to calculate the accrued interest, okay? And this is really the interest that is owed to the seller of the bond when you purchase, or when someone purchases it. So say for example, we'll come down here. Say for example, there was a bond that was issued in January 1st, and let's say you were holding this bond, and let's say the next coupon payment, so you purchased, so this was purchase date, and let's say the last coupon payment was also on January or December 31st, so you've already got all that coupon previously, but the next coupon payment is not until, let's say, June 30th. Okay, so 6 months from now. So if the next coupon payment is on June 30th, let's say you sell this bond, let's say on January 30th, okay? So you've held this bond for, these 30 days, right? From January 1st to January 30th. Well, you should technically be given some portion of the interest payment that will be due on June 30th. And so that's what we're going to talk about, accrued interest. We're going to do an example of this here in the next slide, and I'll show you how to do that. But that's what we're going to talk about, accrued interest, and we're going to need that also to calculate the capital gain or potentially capital losses we see with the bond. So we're going to look at a couple different examples also of holding bonds to maturity and selling them before maturity, the implications for that, and also buying bonds at a premium or at a discount. Remember, the premium side here, this means we're buying bonds, we're buying a bond over its par value, right, or its principal value. Oops. And a discount is buying a bond below, right, the par value. So we're going to talk about all these different examples here. So let's go to the first one, is really to calculate how we calculate accrued interest. And it's fairly straightforward to calculate. Really what we're going to need is three main inputs that we'll need. One, we're going to need the principal amount of the bond, or in this example, the face value. Okay, so here in this example, we're going to have face value of the bond, or the par value of the bond, is going to be equal to $100,000. On this bond is going to pay an interest rate of 6%. The issue date, so this was first issued on January 1st, 2017. The maturity date is going to be January 31st, 2017. We're going to be paid semi-annually. Okay, so semi-annually coupons. Okay, that's going to be due on June 30th and December 31st, so twice during the year. And your purchase settlement date is going to be January 2017. So you're going to buy this bond from somebody who purchased this originally on the issue date, right, on January 1st. You're going to come in and buy this from them at that point in time. Now the question is going to be, well, how much am I going to pay for this bond? Well, you're going to pay the market value price that this has been quoted by the seller of the bond, but then you're also going to have to pay an additional accrued interest amount. And this is what we're going to focus on here, this accrued interest, and calculate how much we're going to have to pay on top of what the bond's price to the seller. So simply, we need really three inputs here. One, we're going to need the par value, the face value of the bond. We're going to need this guy here. We're going to need the interest rate, number two, and then we're going to need how many days out of the year did the seller physically own this bond. So here I have the settlement date. Okay, so this is going to be a key date, and this, different bonds can settle on different days. So again, we're going to go back and kind of review the different settlement periods, whether it's same day or T+2, whatever it is. We'll have to review that, but we're going to assume we're not going to do that here. We're just going to assume we already have the settlement. We don't have to calculate. It's going to settle on January 30th. So what would we do? We would take the par value. So we'd take 100,000. Okay. Then we would times this by the interest rate. Okay. So we can times this by interest rate in decimal format. Then we would times, okay, how many days the seller is entitled to this interest payment. So he held this for 30 days. He's entitled for 30 days, right? From January 1st to January 30th. That's his time frame divided by the number of days in that year. Okay, so 365. If we calculate that, the accrued interest that would come from this bond that we would have to pay on top of the quoted price would be $493.15. So this would go to the seller, the market price plus this amount here would go to the seller of the bond. And that is what accrued interest is referring to. Okay, so now let's go to the next example. And in this next example, we're going to see if you purchase a bond at a discount, you hold it to maturity, what sort of tax implications may come from that. So here's the next example, and the same basic numbers that we can see from the first example. Here, the same one, 100,000, 6%. Issue date was on January 1st, 2017. Remember, if you bought this on the issue date, if you bought this on the initial issue date, there's not going to be any accrued interest. You're just going to pay the principal amount, potentially plus any commissions that come with that. December 31st, 2017 is maturity. Here's the two semi-annual coupon dates. Again, you're going to buy this on January 30th, but you're going to buy this, okay, for $98,000. So you're going to buy this at a discount. Now, the first thing we have to understand is we have to calculate what our potential ACB. Remember, we'll go back to the first slide here. Our ACB for this bond is going to kind of look something like this. Okay, so we're going to have to, so let me just box this in here. The ACB here is going to look like this. The purchase price is going to be $98,000. We're going to have to take off the accrued interest from this. So less the accrued interest. Okay, and that's going to be $493. We did this in the first slide there. $493.15. The ACB then is going to be $97,506. Should be a 506.85. So we have our ACB. Okay, so the next question is, well, how much interest should I report, right? So in this example here, interest to report during the year, so the interest to report during the year, well, I'm going to get two payments, right? So it's going to show that I'm going to get a payment on June 30th and December 31st. So on the June 30th, I'm going to receive a check for $3,000. Okay, thank you very much. On December 31st, I'm also going to receive a check for $3,000. Thank you very much. So I know that I'm going to have some sort of liability in terms of tax for the on that interest. But then I have to less, again, the secured interest that I paid, right? Because remember, I received these two checks, right, for $3,000. But hey, remember, that wasn't all mine. I have to less this $493.15. If I less that, then the interest that I'm going to report for the year is going to be $5,500, just above $5,500, $5,506.85. So that's my interest to report. So we have interest to report. We have our ACB. The next we'll go up here is going to be the capital gain that I may have to report. Because remember, I bought this at a discount here at 98. I'm going to hold this all the way maturity. So that means it's going to mature at $100,000. So potentially capital gain to report. I'm going to take the face value of the bond. Okay, and that's going to equal $100,000. Right over here. And then I'm going to just simply less the ACB. We've already calculated the ACB. The ACB is going to be $97,506.85. Okay, so my capital gain on this transaction is going to be equal to $93.15. Okay, $2,493.15. That's going to be my capital gain on this transaction here. Okay, so I have my ACB, my interest that I'm going to report, and then I have my capital gains. And obviously this capital gains is going to have preferential tax, meaning 50% of this, right? I can use any potential previous capital losses to offset this, and I can potentially, if I had a capital loss, and this is capital gain, I could take this back up to 3 years. So that's the first part of understanding accrued interest. Here, this would be a capital gain example. We purchase at a discount. In the next video, I'm going to show you two more examples. I'm going to show you if I purchase this instead of at a discount. I'm going to show you if I purchase this at a premium. And then one more example, if I don't hold this all the way to maturity, right? If I don't hold this all the way to December 31st, and I sell this before then, I'm going to show you another example of that in part 2 of this video.